Well, that is the closing bell on Wall Street. And now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's trade. Let's see where the major averages ended up here. It was a sea of red here. All the popular averages down hard. Got the Dow down nearly 1,700 points, nearly 4%. The S&P 500 down 4.8%. The NASDAQ down 6%. The small caps down 6.2%. We know what the worry is. It's tariffs, what it means for the U.S. economy and what it means for the global economy and what comes next. These trading partners, do we see negotiations or retaliation? Now to Jared for a closer look at today's sector action. Jared.
Yes, not pretty. Just looking at the Dow, once again, almost 1,700 points here. And you can see we closed at the lows of the day. So that just means, just kind of begs the question, are we going to see a continuation into the next day? And you take a look at the S&P 500. I'll put a one-year chart up real quick. That is going to be the lowest print since about September. It's going to be August for some of these as well. And the worst date, either since 2022 or 2020. That would be the pandemic lows or the bear market that we had in 2022. Now, here is a sector action, not very good. Energy, which had been a safety trade all year, that got smoked the most, down almost 8%. Tech in second place to the end, then consumer discretionary, then industrials, then financials. Only staples, that's XLP in the upper left, was in the green today. Utilities and healthcare and real estate also not as bad as the rest. You can see a few trades still trickling in here. And take a look at the NASDAQ 100. Not a lot of green and just a lot of red. Apple down well over, I believe, $300 billion. Down 9.25%, worst day in years there. Meta down 9%, Tesla down 5.5%, Broadcom down 10%. List goes on. I'll show you the Dow now. We do have more green here. We do have some consumer staples, and we also have some healthcare trades, like United Health had a decent day. That was up 3.4%. Healthcare did catch a bid in certain areas, not biotech, which is a lot more speculative. I'll show you the Dow transports as well, because this is just a sea of red. 100% of these issues close the day in the red. And if I take a look at the leaders, it is a very similar story there. These are just kind of bellwethers that I look at. Some of the worst off, the oil trade down 12%, that small oil down there. Regional banks, KRE down 10%, chip stocks down 10, transportation down 8, innovation, that's the ARK Innovation Fund down 8%, and retail down 8%. So I'll just show you some of the different industry groups. Inside of semiconductors, Intel was a bright spot, perhaps benefiting from the tariff situation. That was up 2%. Nothing else in the green there as far as this board goes. Here's software, very similar story, absolutely nothing in the green. And then here is the smaller components. This is disruption, those ARK Innovation components, seeing a lot of losses there. I have been showing some of the consumer staples because we do need to see a little bit of green here. We can see that in some of these food issues. Coca-Cola and Pepsi each up. Looks like Unilever up as well. And then we also see this in the beverage space. You take a look at some of the quick service restaurants. We call that fast food. Kind of a mix here, but we are seeing McDonald's, which is a very steady, netty chart there. That's up 2%. So leave you guys on a little bit of green. Josh?
Thank you, Jared. For more on today's sell-off, joining us now is Eric Friedman, U.S. Bank Asset Management Group Chief Investment Officer. Eric, it is good to see you. So as Jared was just walking us through there, our stocks tanked today. Eric, what do you make of it? What were you telling clients?
Yeah, look, it's there's no spinning what we saw today. It was a significant downdraft across really everywhere you looked. And I think a couple of things that we've been talking about with clients. I'd say that first, what today represented is really just the classic event risk, where something happened, it could be either good or bad, but unfortunately it was perceived to be bad by the marketplace. And the first wave is just forced selling. These are portfolio managers who are tapped on the shoulders saying, take down risk. These are retail investors who are over their skis in risk and they just sell, and price is really not that important. I think the next wave that we have to really think about is when does that fundamental assessment kick in, which typically takes a couple days after the fact. Look, there's no surprise, if you will, that tariffs were coming. I think the extent of tariffs were obviously the key consideration today. And so I do think that cooler heads will prevail with respect to what is still a decent fundamental picture. Last thing I'll say is this. What we don't know, and no one knows, even though some may claim that they know, is what is the time gap between the immediacy of tariffs with what we may see with things like tax reform or potentially negotiations. It's, again, the immediate aftermath of an event like what we saw yesterday post the market close. That absorption today, that classic event risk, will start to get a little more clarity. Now, we're not going to pay a lot of attention to the jobs data tomorrow. It's obviously important, but it obviously precedes the tariff considerations. So again, the Powell presentation tomorrow will be really important. That for us is critical in terms of what the central bank says, and certainly we can get into more detail there if you have interest.
You talk about tax reform, and I think a lot of investors are sitting back and wondering, hey, where do those animal spirits go that everyone was talking about after November? We were going to be getting deregulation and tax reform. Instead, it's been almost a relentless, barrage of more negative news in the form of tariffs and now a global trade war. Does the president finally begin to shift to the proverbial dessert after serving us all the spinach first, and it's not cream spinach from Peter Luger, mind you?
Yeah, well, listen, that's very good spinach, what they serve. But, Paul, to your point, typically geopolitics sits well in the back seat of the car, if you will. And every once in a while, the driver, which is either interest rates or corporate profits, who tends to sit shotgun, looks back and says, hey, pipe down. That's just not the case right now. We have this unfortunate series of events where we obviously have the immediacy of tariffs, but we don't have the clarity on when we'll actually see tax reform, nor, as I mentioned earlier, when will we actually see more of an active dialogue across global officials. And so the initial salvo with respect to responses from Macron, with responses to what we heard from China, was we're not necessarily going to come immediately to the negotiation table. So what I think that means is there's probably some more spinach, if you will, being handed out by the passenger in the back seat, to mix metaphors. But more importantly, what I think this challenges investors like us to think about is just, okay, where does that fundamental case ultimately kick in? What will consumers do? And we'd already seen before the tariff announcements some bifurcation between higher income, middle income, and lower income consumers. And if anything, the risk is that gap widens and it widens more quickly. So some of the market reaction, we think, is that time gap between moving from the spinach course to the dessert course. But it also, I think, begs the question of when will we see a deterioration in consumer activity? We're not going to learn a lot from the jobs data tomorrow. We will learn from what Chair Powell has to say with more of his forward views. And I'd also just say this is actually not very well covered, but we had Vice Chair Jefferson present today in Atlanta. And again, very intelligent economist. He mentioned in the course of a 3,000-word presentation, this is the parsing that we do, he used the word tariff once in that entire presentation. So what I think that says is there may be a little bit of a hold off of firm communication from the Fed. If we're to use Vice Chair Jefferson's guidance today, there will be a lot of focus on what we hear from Chair Powell tomorrow.
And Eric, final question. I'm just curious, your estimates for corporate profit growth in 2025, Eric, and have you been making any revisions there, meaningful ones?
Yeah, it is really the thing that we're kicking around the most right now is will our $270 number for operating profits hold up? We're actually, again, we had consensus come down to where we are right now. We were, seeing estimates up to 285, 280 to start the year. So we haven't changed them yet, but to be clear, we have to reevaluate them. And not to say that we're going to make the change today per se, but again, back to the idea of the consumer and what they're doing, but also what really yesterday brings into play is what happens with corporate capex. And that had been a very steady contributor to the global economy, specifically tech. If you're a CFO trying to pencil in what your capex budget looks like for the rest of this year and even into next year, your margin of error just widens significantly. So that's something that we also have some concerns about. So again, we'd anticipate consensus to come down. We're certainly going to take a look at our numbers as well.
Eric, always good to have you on the show. As always, sir. Thanks for joining us.
Great to be here. Thanks so much.
While Trump's tariffs wreak havoc on Wall Street, the new duties also paving the way to reshaping global trade. Here with more on the fallout from the Trump's trade policies, we have Ian Bremmer, founder and president of Eurasia Group and G0 Media. Ian, good to see you. So a question top of mind for investors now, Ian, is what comes next with these new Trump tariffs, and specifically how our trading partners are going to react. Are we going to see negotiation? Is it going to be retaliation? We had a guest on earlier in the show, Ian, who said, listen, he expects negotiation with what he described as he's looking for symbolic retaliation. Is that how you see it?
Depends on the country. Before you focus on the next things, let's recognize that, this is pretty heady stuff. You're talking about the U.S. entering an entirely new economic order, leading one. This is a complete undoing of a multilateral free trade environment. The world's largest economy, most powerful country, is putting unprecedented tariffs on everybody we've not seen in our lifetimes. So, there's going to be negotiations. There'll be some capitulation. There'll be some places that'll go full tit for tat. Most won't. But even if everyone was in deal mode, you would still be in a new world order. Because, remember, there are a whole bunch of countries out there where the United States is actually running a surplus with tariffs that are incredibly low. And Trump said, even on those countries, 10%, right? You've got countries out there that are incredibly poor, that provide commodities that America needs and can't get other places. They have no ability to buy American goods. And Trump said, 10%, right? So, the reality is that the purpose of these tariffs is not just to drive deals. It's also to force a reordering of how we think about global investment and make people recognize that the United States is where you need to be if you want to be doing business with the U.S., and there's going to be a cost to that.
Is this the end of globalism, Ian, or do you think, is there the potential for the rest of the world to kind of throw up their hands and say, we don't really want to deal with the U.S. in the same way that we have done in the past, and we're going to forge our own trade agreements, and if America eventually wants to be a part of them, that's all great, but if not, then we're going to do business with each other and see how the U.S. likes it?
Well, there are two ways to answer this. The negative response is that for the last 20 years, there have been a lot of people that have talked about a de-risking from China because China doesn't have rule of law, they're opaque, the state makes decisions that can be arbitrary and capricious, they don't respect intellectual property, all of those things. So everyone's talked about how they can de-risk from China. I have had so many phone calls with leaders of governments and with companies all day today about de-risking from the United States. So you are now, that is the new term of art, and countries and companies around the world are going to find ways to try to reduce costs and get risk out of their system by having less exposure long-term to the U.S. market. That's the bad news. The good news is that the United States is in a position of great power. And there are lots of ways that you can't de-risk from the United States. So look at the hyperscalers, look at the big technology companies. The Europeans are not going to now say, how do we go crush Meta, or Google? And why not? Because they can't replace it with anything. There's no substitution effect. The Japanese can't say, oh, let's go do a deal with China and coordinate with the Chinese against the Americans, because the Japanese can't leave the American security umbrella. So there are a lot of places where you just need to keep working with the U.S. no matter what. And of course, the size of the American market is important. It's not as big as the European collective common market, but it's still pretty damn big. And so ultimately, there are a lot of countries that are going to try to find ways to get along with this new environment, however arbitrarily and unilaterally driven by President Trump.
Ian, what about China specifically? Because I saw headlines today, they're already talking countermeasures if the U.S. doesn't cancel these tariffs. What could countermeasures actually look like? What do you actually expect to see from Beijing?
Well, I'll tell you what I don't expect to see. I don't expect a TikTok deal to get approved by the Chinese anytime soon, because why would they be making a give to the U.S. when Trump is throwing a three handle on top of these new tariffs? And he's saying, well, maybe I'll take a point or two off. I mean, we are very, very far from a breakthrough from a U.S.-China, sort of new Nixon environment, no matter how many people are speculating on it. But the Chinese economy is performing poorly. They weren't going to hit their 5% growth number even before Trump came to town. They're having huge problems with consumer demand and consumer sentiment. They're having huge problems with regional indebtedness, with all of their provinces essentially in receivership. And that gets much harder when the Americans not only hit China, but also hit all the other countries that are passed through from Chinese exports into the United States, like the Philippines, like Indonesia, like Vietnam, right? So when you add that up, the Chinese, yes, they need to respond, and there will be a response. There will be retaliation, but it will not be tit for tat. Where the Chinese can really retaliate is by taking advantage of American lack of interest in leadership. The fact that the Americans want to be unilateralists, the Chinese will be like, great, you want to pull out of the Paris Climate Accord? We'll be the drivers of post-carbon energy transition. We'll be the most important country at the COP summits going forward. U.S. wants to leave the World Health Organization? Great, we'll be the most important country in the World Health Organization. We'll call the shots there. If U.S. wants to stop paying dues for the UN, great. We'll be the most powerful country with influence over the United Nations. U.S. wants to stop spending on USAID, great. We'll be the most important across the world in the global south. Myanmar has an earthquake. Remember when Indonesia had the tsunami? The Chinese failed. The Americans had boots on the ground. Myanmar has a massive earthquake and thousands die. The Americans do nothing, and the Chinese are on the ground. So reputational power, soft power, diplomatic influence with countries around the world, the Chinese see themselves as long-term beneficiaries of what the Americans are doing right now, and that is an opportunity for them.
Long-term Treasury yields have been coming down, and I'm sure the President and Treasury Secretary are happy with that. Any thoughts at all about whether China, which has a pretty significant stake holdings in Treasuries, would they risk hurting themselves to unwind in a dramatic fashion some of those Treasuries to try and maybe push bond yields back up as a sort of retaliatory move?
Your question was in a dramatic fashion, and the answer is no. The Chinese are thinking long term. Their responses are going to be incremental. They don't want a crisis. They want to see how this shakes out for their own economy and as well as for their relations around the world, and they want to move carefully. The term for it in China has always been, when you're walking along a river, when you're crossing a river, cross slowly and feel the stones with your feet because you just don't know where you are. That's what they're going to do here.
Ian, always appreciate your time and analysis, sir. Thanks for joining us.
My pleasure.
Stick around. Much more market domination overtime is coming up. President Trump's steep tariffs forming a challenging landscape for the central bank. Fed officials left with the crucial task of working out the impact of tariffs on inflation. Meanwhile, the path for interest rates remains uncertain. University of Pennsylvania adjunct professor of finance and former president of the Federal Reserve Bank of Cleveland, Loretta Mester, joins us now with a closer look. Loretta, good to see you. First and foremost, Loretta, want to get your take on Liberation Day. What did you make of these new tariffs, Loretta? What do you think the Fed makes of them?
Well, thanks for having me on. The tariffs are going to affect both parts of the Fed's mandate, full employment, maximum employment, and inflation. And it's going to affect both parts over different time horizons. So that's what makes this particularly difficult for the Fed. We know that tariffs act like a tax, so it's going to reduce growth and weigh on the growth side, which means the employment side of the mandate. And then, of course, it will have at least a temporary effect on inflation. The question of whether it'll be more meaningful in terms of inflation, more persistence, is really going to depend on, firstly, whether there is a lot of retaliation and then back and forth and tit for tat, which means that instead of being one shock, it's multiple shocks, kind of like what we saw with the supply shocks during the pandemic. But also crucially on whether inflation expectations remain anchored at levels consistent with 2%, 2% inflation. And that is probably a question at this point because we've already seen some of the inflation expectation measures move up. If inflation becomes embedded and people see higher prices because of the impact of the tariffs, they may start believing that inflation is moving back up again, even though it's come down quite a bit from the peak. And therefore, it can become a more persistent inflation problem. We didn't see that under the first Trump administration. In fact, inflation remained low, didn't move up. And what the Fed ended up doing is having to address a weaker growth economy, and therefore started cutting rates in September of that year. So in 2019. So again, we don't really know how this is going to play out, but I think there's higher risks this time that the tariffs could be inflationary, and that's something the Fed's going to have to keep in mind in balancing both parts of the mandate.
Loretta, the market seems to be of the mindset that the Fed is on hold for a little bit longer, probably not going to cut rates again in May. Jerome Powell, though, to the surprise of, I think, a lot of many market observers, brought back the transitory word when describing inflation at the last press conference. Do you feel that some of these pressures that we might see from tariffs are in fact inflationary, that the Fed could be pausing but leaning more to the dovish side of wanting to cut again? Or are you worried that prices are going to remain stubbornly higher for longer?
Yeah. I mean, even before the tariffs, there were signs that inflation was remaining a little more stubborn than the committee would like, which is why they paused in January. So if you couple that with now this potentially, inflationary shock from the tariffs, I think there's upside risk to the inflation forecast. Now, of course, they'd like to be able to look through the one-of tariff impact on prices. I mean, typically the textbook would say you have tariffs, prices move up, and then inflation moves up temporarily, and as those prices work through to when, there's a new level of prices and inflation comes back down. I don't think they should put all their money on that bet. I think they should be very carefully looking, and I think the chair said this, at inflation expectations, because if they become unanchored, then you have the worst case scenario where you have weak growth and you have inflation moving up, or at least not coming down. So I think they are going to be, being on hold, if you will, but that's really about balancing the risk, right? They're trying to balance the risk of inflation pressures moving up at the same time the economy weakening. And so being on hold at where the rate is now until they're convinced that inflation expectations are well anchored, and then being ready to address a potential deterioration in the labor market seems like a good strategy. The danger with the strategy has to do with how that's communicated, because it could end up being communicated as, see, the Fed was late again, they remained on hold too long, and therefore now they're cutting, but they should have cut earlier. But no, it's really a strategy to balance those risks, to make sure that inflation doesn't get out of hand. And I'm hoping that they begin to communicate more about the objective function and their objectives and reaction function, so that people will understand why they're following a wait and see. It's not because they're asleep. It's just they're really trying to balance what's going on between the real side of the economy, employment, which is part of their mandate, and inflation, which is a very important part of their mandate as well.
Loretta, I'm just curious, how would you characterize the state, the health of the American consumer right now, Loretta? Because I mean, you've seen the recent sentiment surveys, not good, Loretta, and that was before Liberation Day. So how would you characterize it? How are you thinking about it?
Yeah, I think the consumer is nervous. I mean, I think, as a lot of people are, about what's next. And, when there's a lot of uncertainty, and there was even before we knew what the tariffs were, there was so much back and forth on the policies that the uncertainty around it just makes everyone pause and just say, okay, I better not spend a lot of money now because I don't know what's coming next. I better be cautious. And add to that, the uncertainty over the DOGE cuts and what does that mean? There's a lot of people affected by that, not only federal workers, but people who, work with the federal workers. Universities are affected because their funding is getting cut. So there's a lot going on. in terms of the policies here. And even though there's some, there was some kind of hope at the beginning of the year that we'd see the deregulation and, being positive for growth and perhaps tax cuts being positive, I think the uncertainty around the current policies and the tariffs have really, reduced sentiment. We started out the year with very high levels of sentiment, certainly after the election, and now we're seeing very low levels. And so I think the consumers are rightly, sort of let's pause a little bit on discretionary spending and let's wait and see, how, healthy the economy is before moving on. And you talk to businesses and they say the same thing. All the businesses I used to talk to and now continue to talk to tell me the same thing, which is just tell me what the rules of the game are. I can play the game. I can run my business. But if I don't know what the rules of the game are, then I'm going to have trouble and I'm going to be on pause. And that's what businesses are doing now. They're pausing some of their projects because they don't really know what's coming. And so that's how this can, not only the tariffs direct effect, but the uncertainty around policies coming can affect the economy in a negative way. And I think that's what we're living through right now.
Loretta, great to have you on the show today. Thanks so much for your time.
Thanks for having me.
Time now for what to watch Friday, April 4th. We're going to start off on the tariff front. The Trump administration is imposing a 25% tariff of all imported canned beer and empty aluminum cans. Those set to take effect at midnight. That move coming as President Trump's reciprocal tariffs that are in effect today wreak havoc on the markets. Moving over to the labor force, March's full jobs report that is coming out in the morning. Economists forecasting 140,000 non-farm payrolls to be added, less than February's number, while the unemployment rate and hourly wage growth hold steady at 4% and 0.3% respectively on a month-over-month basis. And taking a look at the Fed, we're going to be getting another round of Fed commentary throughout the day that includes Fed Chair Jerome Powell and Fed Governors Michael Barr and Christopher Waller. This is coming after comments from Fed Governor Lisa Cook today. Cook saying she sees slow economic growth this year and stalled progress on lowering inflation due to tariffs. That's going to do it for today's Market Domination Overtime. Our big thanks to Paul R. LaMonica for hanging out with us today. Paul, thank you so much.
Thank you
Covered a
very
lot
much.
of ground. Great day to have you here, by the way.
Yeah, it was a lot of fun.
Thank you, sir. Be sure to come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell. And on the other side of the break, it's asking for a trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the things affecting your money. Stay tuned.